All right, everybody, thanks for joining us for our March monthly production stream. We've got a good one today, so we're not going to beat around the bush. We're going to jump into it. Team joining me today, myself, we got Rob, Chief Operating Officer, Jack, Senior Director, Nat Gas, Jackson Fryer, Energy Analyst. He covers our capital markets, and Julian Renton, who covers NGLs. Now, Jack's with us today, but this really isn't a nat gas story. We'll touch on it a little bit, but this is a crude story right now, and then an NGL story. So let's jump into it. Everybody on this webinar, I think you know what we do. We'll send around the deck after this. You can take a look at this, but let's jump into it. So Rob, you want to walk us through the agenda?
Let's do it. So first, we're going to go through the base case. We call it base case with a 1 month expiration because just 1 month ago, we had our outlook based on what producers were talking about 4Q earnings. That's changed drastically. Leads us to point 2, Operation Epic Fury, and the impact to U.S. energy markets. Certainly, the impact has been longer lasting than most have expected. Julian and Jackson will get into that, as well as the knock-on effects for 1, crude constraints out of the Permian, 2, U.S. LPG, and the opportunity the U.S. may have with India. 3, we did call for $5 gas. What does the current market events mean for that $5 call? We'll talk about that. And then 4, who are the energy companies that are going to win from this? Upstream, midstream, downstream. Jackson will hone in on what he's seeing mostly upstream in this situation.
All right, Rob, thanks. Let's jump into it. Production. Hey, I'm going to bring Jackson in here. Jackson, though, I think it's fair to say this is kind of our base case, right? So why don't you walk us through it?
Yeah, just quick touch on this slide. I'm sure you all are very familiar with. This is our crude outlook, gas outlook, and NGL macro out to 2030. It is the base case from a month ago, right? We are seeing very modest growth in crude, and that's going to change. But again, the market is growing heavily in the gas side, and we'll get into how the dynamic is shifting and what that means.
All right, thanks, Jackson. And next, what are the producers saying?
Yeah, so the title is the Permian T-1 month. The message there was slow and steady, right? Less than 1 month ago, Permian producers, all but one outlier, and that outlier is at the top of the table on the right, ExxonMobil. All others were pounding the table on no to moderate growth, capital discipline, harvesting free cash flow, and what was like, let's call it a $65 to $60 WTI crude price environment. The month of March has felt like a wild year. It has been a long month, and I do mean that. There's been a lot that's happened. Jackson will go over that in a minute. How might this rapid change that we've experienced impact how producers respond, particularly out of the Permian? So let's talk about that.
Awesome. All right, guys, we're going to bring you into what we talk about and the excitement we have around this current market story. So, Julian, walk us through how Epic Fury pushes WTI curve higher and what we're seeing.
Yeah, thank you, Chris. Since the beginning of the conflict or Operation Epic Fury, we have seen crude prices rise, especially the average forward strip for 2027, about $11. So you're going from a $61 average pre-Epic Fury, that's February 27th, to now, today, or the 19th, when you saw the average price be $72 for 72 for 2027. So what does that mean? We've increased price $11. That already means that's a large move, enough for producers to start hedging and start changing how they're thinking about production heading into 2026 or into 2027 as well. And we expect, if you look at the prop month now, around $9,500, that this persists. That is kind of the likely scenario, and that is what we have chosen for our high case scenario, $100 to run to that scenario.
Just like boardrooms, which we know is happening right now, we went into this, this is going to be 1 week, this is going to be 2 weeks. We're going to play this out. Producers won't change. But now it's, hey, you got to get on it, and you got to start to understand what this means for the market.
Yeah, I think you can definitely see that in the chart, Chris. As we have progressed through time, you can see the forward curve has shifted out further, and the backwardation has gotten less steep as time goes on.
All right, well, let's jump into the high case here. $100 oil, Julian, that's a big one.
Yeah, that's right, Chris. And we have both cases side by side to compare. What does that mean for rigs? What does that mean for price? rigs, really, you're only looking at a difference of 60 rigs between the base case and the high case, but that is a large amount of production. With the efficiencies we have now, we expect around 500, an uplift of 500 MBD on the crude side, 1.7 BCF, and around 350 MBD on NGLs. So that has downstream effects on utilization on the pipes, processing capacity, and companies who are going to win.
Well, speaking of utilization on the pipes, we haven't got to talk about that in a while with crude, but things are looking different.
Can I interject one thing,
please?
Chris? Can you go back?
Yep.
Because Julian said, I think you said only 60 rigs, and that is a lot of rigs. So people might say like, whoa, 240 to 300, that's a lot. And it is. We actually took the relationship of crude to rigs and muted that relationship significantly, knowing that capital discipline, free cash flow still matters. Rigs are more efficient. So if you just extrapolate that relationship, you get a lot more than 300. Now the big question is, which producers will move and how fast, and do we actually get up to 300? But that is a muted view relative to historically what we've seen.
Yeah, I mean, that's a 25% increase from where we're sitting right now.
Yeah.
So that is big. And we will get into the producers and who's going to win a little bit later. There's a tease. All right, let's talk about takeaway utilization. I mean, it is going to get interesting. It's fun to see crude in the news again.
Yeah, that's right, Chris. So 500 MBD on the crude side is very significant when you're looking at the Permian. Right now, open routes, Corpus Christi, you have around 270 MBD. Houston, 280. Cushing, you have 440 MBD of available capacity. We expect those routes to fill in that order: Corpus, Houston, Cushing. Corpus and Houston will fill first because of the pull of export demand. Cushing will fill last because you're kind of taking a longer way to market. You're filling Cushing and eventually making your way down to the Gulf Coast through a different pipeline. So it's a more indirect route. So what that means is that the pipes that are going towards Cushing or towards from Houston or Corpus Christi are going to face pressure first. And just look at the Corpus Christi route. You're looking at Gray Oak, Cactus 1, 2, and 3. Those are the likely targets for expansions when you have higher utilizations going that way.
So by pressure, you mean whoever owns those is going to feel really good. We talked contrarian view, Jackson. We said this earlier. Plains with their contrarian view seems to be able to capitalize in this environment.
Yeah, they went from, hey, we're capturing synergies, and everyone kind of wrote them off, to they are perfectly in line with this bullish crude scenario and really set up well.
That's why we all love this industry. Things change on a dime and they change every day. It's always something to talk about.
So there's really two things, Jax, I'm hearing. One is anyone who has marketing capacity can gain from having this space. 91% utilization, by the way, is usually, or anything above 90, even 85 sometimes, is when we see spreads blow out. So in an environment with 300 rigs, the spread from Midland to the Gulf Coast, we would expect that to widen. And the second thing is, from an infrastructure perspective, there's opportunity for Gray Oak, Midland Taco, and Epic to expand in this environment where more capacity might be needed. So a couple opportunities there.
Well, and is it fair to say, Rob, I mean, there's preferred routes, right?
Definitely.
So we say 91% here, but as Julian pointed out, as they're going to fill, Corpus is already going to be pushing that at this point in time.
Yeah, definitely. The Gulf Coast, more favorable pricing versus Cushing. So Cushing would be the last leg to fill up. You're absolutely correct.
All right, next let's jump into gas. And it's fun to talk about gas in a different way than we've talked about it for a while, right? All waiting for the build. Now we're just going to blow right through it. So guys, can you jump in here?
Yeah. So bullish crude is bearish gas. As you guys know, we've come out for the last 6 months plus with a very bearish gas case, and that was driven by structural undersupply from all the LNG demand coming online, and we didn't see the Haynesville or the greater basin of the Arklatex ramping to meet that demand.
Bullish gas case?
We were bullish
Bullish
6 months ago.
price.
Bullish
Yeah.
price. Thank you. Thank you, Rob. Yeah, we're bullish on price 6 months ago, and that was really because we didn't see the Arklatex or the greater Haynesville ramp, and the crude price wasn't there incentivizing growth in the Permian. And now with this crude incentive of the price and the forward strip where it is, in this scenario, it's very bearish, the outlook for gas. So what we're looking at here is the total takeaway capacity in the dark blue, and you're going to see we're going to run into egress constraints very quickly out in 2031, 4 years prior than in the base case. Also, in the next 2 years, we're going to start to see some Permian processing capacity constraints on the gross gas side. And that's to be flagged, but a lot of these plants get built with 2 years line of sight. But back to the marketing side, like Rob was talking about, these routes, especially on the eastbound, have been continuously recontracting to more firm transport to get away from marketing. Because for a long time, the outlook was, hey, we're going to be overbuilt on eastbound egress routes out of the Permian. Your Waha to Henry Hub spread is going to come more in line, and your marketing is going to be worthless. You know, you're not going to be able to exercise that call option as frequently. However, in this case, the laggards and the ones that haven't really rolled that marketing volume into a firm transport volume are actually going to win, because now they have all this marketing capacity in this case that they can exercise and capture that spread when the Waha blows out.
Is it fair to say that a lot of the questions you're getting from our clients right now are, one, marketing arms leverage in this, and two, who's going to start to announce processing capacity?
Yeah, definitely on the side of marketing, there's a ton of questions of who's going to win, who's going to be able to capture it, and who has the most amount of volume available, like of equity gas volumes that they can capture this spread on.
Well, I won't ask you who you think, but if you want to know, give us a call. All right, guys, let's, the light end is the right end, as Julian always says. Let's talk LPGs and think about the structural difference now, really with shipping routes around LPGs and what we could see.
Yeah, Chris, that's a good point. So in our high case, we see an additional 345 MBD of LPG production out of the Permian Basin available for export. There's plenty of space on the docks with those expansions coming online. What we're seeing there is the EIA has called 1.5 million barrels a day of LPG supply being disrupted from the Strait of Hormuz. And that has created a LPG shortage worldwide, especially for Southeast Asian countries. Specifically, India is feeling the crunch, where they rely on most of their LPG for heating and for cooking. So when you're a country like that that's so reliant on LPG imports, you're now starting to realize how quickly that can be shut off in an event like this. So you start thinking, how do you diversify your supply? How do you increase your energy security? And the answer turns to be the United States, where you have the largest LPG export capacity in the world and the most supply available. The difference there is that the route is 40 days from the Gulf Coast to India's East Coast, where from the Strait of Hormuz is 5 to 10 days, depending on where you're going. So what does that mean? That just means bullish tanker rates, and you start to see high utilization of those rates.
So Jackson, I want to bring you in. Who can take advantage of this situation?
Yeah, so funny you ask. Really unfortunate timing on Targa's part, where their Galena Park facility went down and declared a force majeure. They are at significant risk, and they can't move the LPG volumes right now. So ET and EPD, even though they are tight on the export dock, and running about 95% utilization, those spot prices are going to capture a massive premium to the already locked in ones.
And you said that Galena Park, you told me this earlier. What percentage of that is to Targa or their export capacity?
I think it's about 80% of their export capacity at Galena Park there. So they're going to take about if the issue persists for 2 months into the second quarter, they're going to take about a $48 million hit.
Ooh, yeah, bad timing.
Yep, on their operating margin. Yeah. So definitely, bad timing for Targa.
All right, we're going to jump into the next slide, but Jackson, I'm going to have you do this slide because there's something that the market is missing, we feel, and I want you to slow down and really nail what it is, because there's timing issues here.
Yeah, the real piece is the market is pricing this as open or closed, and they're starting to realize that it's not a binary headline, right? There's real logistical issues and supply chain issues that you have to deal with. So just some high level math, the market, in order to reset, is about 8 to 12 weeks round trip from Hormuz to Gulf Coast, right? And then is about 6 to 8 weeks Hormuz to Eastern Asia. So that's the math. And just because it opens and it's been closed for about 20 days now, doesn't mean that it will immediately reset and normalize. Like you have to deal with tanker backlog, loading delays at terminals, then the cargoes have to sail, discharge, and then cycle back. So all of that time is 8 to 12 weeks to the U.S. Gulf Coast and about 6 to 8 or even about 6 to the East Coast of Eastern Asia.
Well, and the interesting part too is every night, I know Rob always posts the X feed of another facility going down in the Strait of Hormuz, which is going to change these dynamics differently and only push out what you're talking about.
Yes.
All right, so let's jump in because we had a crude story, but not all crude is kind of the same, right? And so what does this mean for crude quality? And I know we're going to bring in Venezuela here a little bit and talk about that.
Yeah, so the constraint really is the crude quality and not just volume. The Hormuz barrels are very medium sour and have medium heavy barrels. And you can't just replace those with a WTI as a feedstock for your refining. You're going to have different margins and different yields with a different feedstock. So WTI and Brent have repriced higher, not because we're really physically short those barrels, but because they're the index. So the people that are really benefit is Canadian barrels with their medium heavy sour that they can pull. And we expect a lot of those routes to be running full or as full as they possibly can, pulling out all the stops to bring the supply into the Gulf Coast refinery complex and PADD 2 refinery complex.
All right, so we got Canada. Julian, you mentioned earlier we're seeing ships divert to the U.S. from Venezuela.
That's right, Chris. If you chart out the Venezuela oil exports to the United States ever since that operation down there, you see them steadily increase to about 300 MBD, maybe a little bit higher now. We're not seeing increased productions. We think that's going to take a long time and investment in that infrastructure to actually increase the production, but we are seeing flows reshift specifically away from China and other Southeast Asian countries, more towards the United States.
So what I hear you saying is the U.S. is going to get their crude and
Yes.
the grade they need, the quality they need to run our refineries.
That's right, one way or another.
Well, let's get into that. So we're seeing low inventories and the strong run make the U.S. part of the shock. So you guys want to jump in here? What are you saying?
Yeah, the third point here really is the U.S. is not sitting outside of this shock. It really is part of it. The U.S. entered this disruption with low inventories and really limited shock absorbers. As you can see by the chart in the bottom here, the gold line is the historical 5-year average of storage at Cushing. And then the blue line is where we sat over the last year. You can see we're very undersupplied and have a low level of storage. And that's really removing the U.S. Shock absorber. So that's why the spread move matters as well. It's not just a financial response to headlines. It is the physical signal that U.S. buyers are having to bid higher and harder for available supply because imports are less reliable than the domestic market. And yeah, so the low stock plus strong refinery runs and pull mean the U.S. is going to help absorb the shock, but through that bullish price call, causing producers to increase.
All right, speaking of producers, let's talk about it because I think this one's really interesting. We did a little bit on who can take advantage of this, this change in dynamics. Jackson, you want to run us through here?
Yeah, so when we bring this back to equity earnings, the message is to be careful about assuming that spot prices translate directly to near-term upside, right? A spot price doesn't mean one for one that a company is going to realize that. And that turns into hedging profiles and some open barrel math. So that's what we did here is really looked at these companies and said, hey, how many open barrels do they have that they haven't hedged on? And then what do their hedging profiles look like to how much upside can they capture? And EOG really came out as a winner because they don't hedge and they're very opportunistic in realizing these volatile environments. Matador, on the other hand, hedges about 50% of their volumes through collars. So they're going to be a lot more muted on the earnings side because of that. And this is a revenue directional illustrative call that's based on their open barrels as well.
Good time to be in EOG.
Yeah. And Jackson, you had said earlier that these are the winners right now. However, they can't really change their profile for the next 3 months. So who are going to be the producers that first react to this price signal? Is it going to be EOG that has nothing hedged and they can just grow into higher prices, or is it going to be smaller producers?
Yeah, it really depends on their hedging duration, and producers really change their outlook based on duration of the curve, not the spot price. So as the duration changes, it's the question becomes, at what point are producers going to lock in these prices and grow into that?
I think back to the chart you showed earlier, Julian, the initial forward curve had a spike, and then that spike was tempered, meaning the market really thought that this was going to be a short-term 1 week, 2 week thing. Well, now the slope of the curve is a little bit more shallow, and it's resulted in a higher price in 27 that producers can lock in at, what was it, $75 or something like that.
Mhm.
It's materially higher than what we were before, 60 up to 65. 75 is materially higher. I think we do see some behavioral shift at the margin.
So does that mean smaller producers that run 1 or 2 rigs come back because they're able to lock in higher prices, and they don't, even if prices go back down, they're the ones that are nimble enough to react to that situation?
Could be. I mean, that's one of the big things that I'm curious to see who kind of blinks first on adding rigs. I mean, we are in, I think, a different type of market. I don't think we're going to see the same type of response we would have seen 5 to 10 years ago, because inventory is a concern in maintaining your tier 1 or your best drilling acreage. That's still a variable that they're going to consider, but I do think you see some adding rigs at the margin to drill the higher price.
Yeah, it brings up a good point. I'm really interested to see how the smaller, even the privates, strategize into this. I mean, there was a lot of private equity money out there that flowed into some of the privates, and we'll see how it's a great time to capitalize on that investment.
Yeah. I mean, maybe Harold Hand adds a rig or two in the Bakken too.
Could be.
Continental comes back.
Yeah, exactly.
Yeah, maybe we'll see it. All right, everybody. That is the end of our presentation. Sign up for our free newsletters.
Can I do corrections, clarifications?
Corrections, clarifications. Yeah.
So on that, I have two things. One, Jackson, you said our outlook was to 30. We showed it through 27. If anyone has questions on our outlook, crude, gas, or NGLs through 2030, don't hesitate to reach out to us. We just focused on the next year really for this one. And two, this could be a follow-up, Jackson, on the force majeure for the LPG. Is that hit to target contractual or repair costs? Because I think on a force majeure, it'd be isolated to repair costs, not contractual liability. Yeah. Is that right?
Yeah.
Okay, just want to make sure there. That's all I got, Chris. Sorry.
All right. Well, as usual, when we end this, here's the team, but I'm going to ask each one of you. I told you what I'm looking for, the privates, and see how they respond. But Jackson, what are you watching for?
I'm watching rigs.
Pretty straightforward. You did say you were watching something else, though. What was it?
Yeah, also it's a short-term indicator. I'm going to watch Waha to see where that production comes online. I'm using gas and then I guess WTI Midland pricing to help.
Yeah, gas is kind of that price, probably a precursor to the crude coming out as well. Julian.
Chris, I'm looking at propane storage.
What?
I know. I've always looked at propane storage. Right now, we are at the highest level propane storage has been at this time of the season ever, and we're exiting the heating season. Means we're going to start building stocks again. With Target going down, that's a lot less export capacity for propane. I'm seeing record hot dog sales this summer, Chris. Propane is going to be so cheap. They're going to be giving it out for free. Everyone's going to be using the grill all the time.
All right, I'm going to go fill my 5 tanks in my backyard tonight. Appreciate it. Rob, what are you watching for?
Jackson took mine was rigs, so I'll switch it. I think, following the Russian invasion of Ukraine, we saw structural shifts in how energy gets to market, how supply gets to demand. The big thing I'm looking for is when you see shifts in how supply gets to demand, like Julian called out with LPGs, taking the longer route to India, do we go from what we were prior, which is the efficient route, to an energy secure route? And I don't believe all that shifts from the U.S. to India on a long-term basis, but I do wonder what changes more permanently after a conflict like this. I mean, certainly with what has happened with Qatar's LNG facilities, I think there are some real concerns about, do you diversify some of your supply? What is the impact long-term with LNG contracting and things like that? So for me, it's, do we go away from efficiency to energy security in some cases?
Yeah, it's going to be interesting. Well, guys, I hope you're ready, because we may be recording a new one of these in 2 days when things change coming online. But hey, everybody, thanks for joining us. Reach out if you have any questions. We'd love to talk to you.